But you're not going to expect any overnight jump. So let's start with the 30-year fixed mortgage rate at the moment. And you're seeing on your screen right now where the Fed benchmark is, so 2.5%. But the 30-year right now, I remember in November when it was well above 5%, it's climbed down to 4.62%. So we're seeing that a little bit lower. According to Freddie Mac, that's 8 weeks in a row where we've seen declines or staying relatively flat. The 15-year one, flat, 4.07%. And the 5-year actually went down below 4%. So you've seen those rates. One rate, though, if you have a home equity line of credit, that has climbed higher because that's a variable rate, so that's prime plus 1%. So you should see it at about 6.5%. So if you take that out of the equation, some of those mortgage rates I just mentioned, buyers are starting to take notice. You're seeing home loan applications climbing higher as these rates decline, and existing home sales for 2 months in a row now, much to the surprise of many analysts and economists, have actually climbed higher. So what else could affect you with this rate hike that we saw yesterday from Jay Powell? Let's talk about maybe some savings accounts. If you have a high yield savings account, then you should see an average of about 2.4%. But if you just have an average savings account, no, that's not going to change. It's probably going to just hover on an average of 0.2%. So the suggestion from some experts is to switch to online banks because you can get a higher savings rate. And if you're not into savings, let's take a look at what you're seeing on your screen now. Credit card debt. Credit cards, we know, are variable, so we should see an increase in 1 to 2 billing cycles. Right now, the average is 17.65%. And the average American household, how much are they spending on their credit card? Right now, their debt is at $6,929 for the entire year. They're paying a lot, over $1,000 in interest. If you're talking about cars, because we're going through it all, we want to make sure that everybody knows what's affecting them. New 5-year car loans, they're seeing their rates at 4.93%, so not likely to change. And last but not least, student loans and student debt. So that would be private loans, not federal loans. Private loans to make the offset between your savings and the federal loans. Those are most likely going to climb higher because they are variable and they are pegged to the Treasury bills. On average, students have about $30,000 worth of U.S. debt when they come out of school.